I'll be hosting today's presentation. My name is Julie Chapa, and I am with the Lender and Partner Activities branch of the Single Family Housing Guaranteed Loan Division. And for the next hour today, we are going to talk about ratio requirements for the guaranteed program. Now, before I start diving into the presentation, for those that may be new to our live training sessions, the goal of these events is to give you a helpful overview of program requirements. So today, again, we'll be focusing on Chapter 11 of the 3555 Handbook, which covers ratio requirements. Now, we're not going to read the entire handbook chapter together this afternoon, I promise. Instead, our goal with these trainings is to walk through key points, go over some real life scenarios, and highlight where you can find answers and resources when questions come up. You can always return to the handbook later on for the full details, and you, of course, are welcome to email or call us whenever you need clarification. Whether you're brand new to the program or you've been working with it for years, I'll do my best to keep a pace this afternoon that works good for everybody. Hopefully, I'm not going too fast for everyone or too slow for everyone. But again, if you have any questions on any content, you can just drop a question in the Q&A and our team will be happy to clarify anything for you. So with that, we will get started here and we will try to make this as useful and down to earth for you as possible today. So let's get started this afternoon with the basics. USDA uses two standard ratios. We have 29% for PITI and 41% for total debt. Now, these aren't just some random numbers. They're really a test of long-term affordability. And at their core, ratios help us answer one key question, and that is, can this household comfortably carry this payment month after month? Ratios are protections for both the borrower and the lender. So, to understand the 29% limit, we need to take a closer look at exactly what is included in PITI. PITI includes more than just principal and interest. We're also looking at taxes, homeowners insurance, the annual fee, supplemental insurance when required, and any association dues like condo or PUD fees. And just a quick reminder, the GUS proposed monthly payment section needs to capture all of these items. Missing something like supplemental insurance or an HOA fee is one common issue that we do see. So now let's switch gears and talk about the bigger picture, the total debt ratio. When we talk about the total debt ratio, think of it as everything stacked on top of PITI. All of the borrower's recurring monthly obligations through closing. That includes installment loans, revolving debt, student loans, co-signed accounts, business debts that appear on personal credit, and more. Even non-medical collections and judgments must be documented, and a payment may need to be included. But remember, not everything counts, and we do have specific exclusions, and we'll walk through those so you know exactly what stays in and what can be left out. All right, so here we are looking at the different types of debts that roll into the total debt ratio. We have consumer credit, student loans, business debts, leases, court ordered obligations, and co signed accounts. A key thing to remember is if the credit report shows a balance, but no minimum payment, we default to using 5% of the outstanding balance unless we have verified documentation showing a different amount. All right, so let's walk through the main types of everyday debts and the smaller details that truly matter during underwriting. For installment loans, we always count the payment. The only exception is the 10-month exception. If 10 or less months of repayment remain on any individual account, the monthly debt may be omitted if the payment does not exceed 5% of the monthly repayment income. Now, on this side here, we have an example with Maria, and she only has 8 payments left on this debt, which seems promising, but her $310 payment is still more than 5% of her income. So in this case, that payment must stay in the ratio. So for revolving accounts, we normally use the minimum payment shown on the credit report. If there's a balance, but no minimum payment listed, we apply that 5% rule. And then if we have a more current account statement, we can use the actual verified payment instead of the credit report amount. Now, if the balance is zero, no payment is required, and we are not going to require that that account be closed. All right, so now let's take a look at open 30-day accounts. These often raise questions because they don't operate like typical revolving debt. The key with these is the payment history. If the borrower has paid the account in full every month for the past 12 months with no late payments, and so I want to emphasize no late payments, we can exclude it from the total debt ratio. But if there's even one late payment or we don't have complete documentation, then we must count either 5% of the outstanding balance or the full balance, depending on what the credit report shows. All right. So in this next section, we're going to talk about student loans. Student loans, they always count no matter the repayment plan. And this is an area where lenders have a lot of questions. So we want to walk through the rules with the different types of student loans. All right. So again, no matter the repayment plan, whether it's an IBR, deferment, forbearance, or even expected forgiveness, here is a pro tip for you. The golden rule of student loans is that they are always included in the total debt ratio. Even if somebody else is making the payment, such as a parent, student loans that are in the applicant's name only must be counted regardless of who is making that payment. Now, if there is a payment above zero, we use the amount shown on the credit report or the verified documented amount. Now, if the credit report would show a $0 IBR payment, we must use 0.5% of the outstanding balance. Now, for those student loans that are in deferment, you want to use the payment on the credit report, the actual documented payment, if it's greater than zero, or again, 0.5% of that outstanding balance. So, deferment does not eliminate the obligation. And even those student loans that are in forgiveness, if they are expected to be forgiveness or forgiven at some point, the debt still counts until the creditor issues an official release of liability because the borrower still remains liable for that debt. All right, so now let's look at how these rules play out in real situations. So in this example here, we have Darius, and he has an IBR payment that shows zero. So here we need to apply that 5% rule based on his balance. And in this scenario, we have Priya, and she expects loan forgiveness in the future. But until she receives an official release from the creditor, that loan must still be included in her debt ratio. All right, now let's take a look at cosigned loans. Those are another area where questions come up frequently. So let's take a closer look at how USDA treats these. So cosigned debts are pretty straightforward. They count unless we can clearly document that the applicant is no longer responsible. To exclude them, we need one of two things. We need either a full 12-month payment history showing the other party has made the payment on time, or we need written confirmation from the creditor that they will not pursue the applicant if the primary signer defaults. There is one important exception here, and that is in divorce situations. If the court order assigns the debt to the ex-spouse, the applicant does not need to show 12 months of payment history. The decree itself is enough. But in all other cases, if even one requirement is missing, the debt stays in the ratio. All right, so here we have again a couple real life scenarios just to kind of help further explain these requirements. So in this example here, in this divorce example, the debts assigned to the ex-spouse can be excluded because the court order shifts that legal responsibility. No 12-month payment history is required because, again, this is a divorce situation and we're going to assume that they have all of the proper documentation that they need. Now, in this example here, this is a cosigned auto loan. This one's a little different. With this one, the sister has made every payment on time, but only for 7 months. Again, remember, USDA requires a full 12-month history to exclude those cosigned debts. So because we only have a 7-month history here, that debt has to stay in the borrower's ratio. Partial payments are not enough. All right, now we're going to move on to some of the non-traditional type of debt categories. Those may include things like business-related debts, buy now, pay later accounts, which are becoming more common, leases, balloon payments, and a few other types of debt categories that might need a little extra attention and documentation. The key here is simply recognizing when something requires a closer look before deciding whether it belongs in the debt ratio. All right, so here we're going to start with business debt. So when a business debt shows up on someone's personal credit report, we can only leave it out of their DTI if three separate things align. So the first thing that we're going to be looking at is the money paying that debt has to be coming from a business account, not personal funds, true business funds. Then the second thing that we look at is we need to actually see that that is happening over time. So we look for a 12-month payment history, usually bank statements or canceled checks showing the business has consistently been making those payments. And then third, the debt needs to show up in the business's own financials. So either a profit and loss statement or the cash flow analysis. That's what confirms if it really belongs to the business and not the individual. So again, if any one of those pieces is missing, the debt stays in. All right, so now we have another real life scenario here. In this example, Sam is self employed and has two business related debts that show up on his personal credit report. The lender wants to know whether those debts can be excluded. So, to answer that, we need to walk through those three steps that we just covered. So, step one, are the payments coming from a business account? And we can check that yes, based on what we know, both of those are being paid out of his business checking account. Then, step two, do we have a full 12-month payment history showing the business has been making those payments? And again, based on the information and the documentation we have, it does show that the business has been making those payments for at least 12 months. So then the third step, do those debts show up in the business financials? And they do. Both appear clearly in his profit and loss statement as business expenses. So with that, Sam meets all three of those requirements. So both of those debts may be excluded. But again, if any of those pieces are missing, they have to stay in the ratio. When we look at those buy now, pay later accounts, those often are not showing up on credit reports, but they do show up on bank statements. When you spot these transactions, document the outstanding balance and the payment terms. Then enter those into Gus and determine whether they can be omitted. The key with these is simply just not overlooking them. If they appear on the bank statement, they need to be reviewed. When it comes to leases, those are, again, pretty straightforward with USDA. They always count in the total debt ratio. Unlike installment loans, there is no 10-month exception for leases, whether it's an auto lease, a solar lease, or another type of equipment, energy lease. The payment must remain in the ratio regardless of how many months are left. This is one area where lenders often try to apply the installment loan rules, but again, remember, leases are different. We always have to include those payments. Looking at deferred and balloon payments, those also remain in the total debt ratio, even when the payment isn't due for months or even years. USDA still requires a monthly payment amount to be included. If the creditor provides documentation showing the future monthly payment, you can use that amount. If you do not have that, then we are going to fall back on that default of using 5% of the outstanding balance. So, really, the goal here is to capture the borrower's true long term obligations, not just what they are paying today, because we want to help ensure sustainable repayment for this borrower. All right, rental properties. So this slide is actually going to focus more on repayment income because repayment income is really what is going to determine how much of that debt actually ends up being included in their ratio. So for rental properties, USDA looks closely at the borrower's history. What determines if rental income can be used for repayment to help with that debt ratio? So, with this, if the borrower has received rental income for at least 2 years, that income may be considered for repayment purposes. Now, if it's less than 2 years, that means the rental income cannot be used for repayment. Even if the rental arrangement seems stable, if it's less than 2 years, it cannot be used for repayment. And then, if the borrower has had a late mortgage payment on a rental property within the last 12 months, we must count the full mortgage liability, including all associated costs with that mortgage, in the total debt ratio. Again, this just helps ensure we're evaluating repayment ability accurately. All right. This non-purchasing spouse debt is unique to certain states and territories. The basic rule for non-purchasing spouse debts for these community property states are that if an applicant lives in or is buying in one of these states, you have to include the non-purchasing spouse's debts. Those debts are going to be verified using a non-purchasing spouse credit report pulled outside of Gus. And then you're going to have to manually enter those liabilities into Gus. There are a few exceptions. Some states allow certain non purchasing spouse debts to be excluded. If that's the case and those debts are left out, then it is the lender's responsibility to document in their permanent loan file documentation to support that exclusion. USDA does not have the laws for every community property state. We cannot provide guidance on that. It is the lender's responsibility to know the laws for each of the community property states and what can be excluded. And it's also important to remember that state laws change. So just make sure that you are staying current with all of those rules for those community property states. Don't assume, always check the latest requirements. If you're always going to include these debts, then it doesn't matter. But it's when you're looking to exclude them, that's when you have to make sure that you are abiding by the most recent laws. All right, so now we're going to take a look at court order debts, timeshare fees, and authorized user accounts, because these are three categories that have some unique rules that affect the total debt ratio. When we look at court order debts, so like child support, alimony, garnishments, the payment must be included unless there is a documented release of liability. Payments must match the court order, and if there are 10 or fewer months remaining, they may be excluded. But again, you need to look at that 5%. So if the payment is 5% or less of their repayment income, and then you have 10 or less months remaining, you can exclude it. But if that payment exceeds 5% of their repayment income, you have to leave it in regardless of the number of months remaining. Timeshare maintenance fees, those do count as a long-term debt and should never be overlooked. They often appear in credit reports and they have to be included as well. For authorized user accounts, the key question is whether the borrower has any legal responsibility for this debt. If they are strictly an authorized user and not legally obligated, then the account may be omitted. But if there is any shared liability, you have to leave that in. All right, so here's a good example of how a debt can be omitted from the total debt ratio. So here we have Jerome, and he's just over the limit. So the lender suggests paying off a credit card at closing. I think we this is something we commonly see, and of course USDA does allow for that, but only if the payoff comes from Jerome's own verified funds. Seller credits or loan proceeds cannot be used to pay off debt. So the lender also needs to document where those funds came from and get a statement that's dated within 30 days of closing, showing the account will be paid in full. And then all of that goes into the permanent low file. So if Jerome pays off the debt with his own savings and it's documented correctly, the debt can be excluded, which helps him meet the ratio requirements. I want to just make a note here regarding gift funds. Gift funds are considered the applicant's own funds. Therefore, in a scenario like Jerome's here, gift funds could be used to pay off this credit card debt. All right. So when we started a little bit ago, I had mentioned how there are some debts that can be excluded from the total debt ratio. So here's a few of the most common ones you'll see that are allowed to be excluded. The first one I want to point out is medical collections. Those are never counted, even if they appear on the credit report. Utility bills, union dues, those are personal living expenses and are not credit obligations. So those are not included either. And then childcare expenses. Even though those can be quite a significant monthly cost, those are not included in the debt ratio either. Really, our goal here is that we want to count true recurring credit liabilities, not just those day-to-day expenses. But again, something that I want to point out is if one of these obligations, let's take like a utility account, if that ever goes into collection, it then becomes that adverse credit. A payment at that point may be required. and to see whether or not a payment would have to be required for those non-medical collections or judgments, you would want to refer to Chapter 10 of the Handbook. That gives additional guidance on those specific situations. All right, so now we're going to take a look at some quick scenarios that show how these exclusion rules work in practice. So, in our first scenario here, there are utilities on the credit report, but utilities are always excluded. So, those are going to be omitted. In our second example here, there are childcare costs that are substantial, but they're also excluded from that total debt ratio. And then here in this example, there's an IRS repayment plan. Now that one is included because tax repayment plans do count as monthly obligations unless it meets that 10-month 5% exception. So if there is those 10 or less payments remaining and the payment does not exceed 5% of the repayment income. So again, just a couple more examples to hopefully help this all kind of make a little bit more sense. All right, so now we're going to shift gears a little bit into ratio waivers and compensating factors. These come into play when a loan's ratio exceeds those standard 2941 limits. Think of compensating factors as additional strengths that can help support the borrower's case, offering flexibility when the ratios alone don't fit neatly inside the box. What might we be able to do to help those borrowers? The key takeaway here is that when Gus gives an accept, you're done. No debt ratio waiver is needed. You can move on. Now, for those Gus refer with caution, or if the file is manually underwritten, then in those cases, all of the following must be met. The ratios must still fall within 3244. Those are going to be our maximum thresholds for the ratio waivers. And then the next thing that we have to look at is that all applicants must have a validated credit score of 680 or higher. So again, want to point out that that is all applicants that are on that loan have to have a credit score of 680 or higher. And then we need to ensure that at least one documented compensating factor is present. And here is just a summary of those compensating factors that can be considered for a waiver. Again, you always want to defer back to the handbook for how that's all specifically worded for the specific guidance. But here, these bullets give you a pretty good idea of what you can consider for a compensating factor. So the rule's pretty simple. If it's an accept, no waivers required. Anything else, you need to follow this compensating factor path. All right, so now we have another scenario here that kind of brings those waiver rules to life. Here, our borrowers, their ratios fall under the cap of that 3244. And then we have both applicants have credit scores of 680 or higher. And then they also have over 3 months of cash reserves after closing. So then that's more than the amount that's needed to qualify for that compensating factor. So even though one of the borrowers doesn't meet the full 2-year employment requirement, that's okay because the reserves alone are enough to meet that compensating factor. So we can use that as their compensating factor, and we don't have to ensure that they both have a full 2-year employment history. Now, if they didn't have those cash reserves, then we would have to look to one of the other compensating factors, and that's where the employment history might come into play. So in this case here, the scenario on the slide, yes, a debt ratio waiver can be considered. So again, this is just a great example of how strong documentation can help move a file forward. Refinance loans, they follow a slightly different path when it comes to waivers. Again, if Gus returns and accept, a waiver is not needed. Just like the previous slide, we were talking about purchase loans on that previous slide. Again, Gus accept, no waiver needed. If it is a Streamline Assist refinance, Streamline Assist refinances, they do not require a debt ratio calculation, which means a waiver is not going to be required either because we're not looking at that debt ratio calculation for those loans. Waivers only matter when Gus returns a refer with caution, or the file's manually underwritten. And unlike the purchase ones that have the purchase waivers that have the maximum threshold cap, for refinance transaction, we do not have that cap. We also have a little bit more flexibility on the compensating factors for ratio waivers for refinance transactions. One thing I'll point out on this slide here is you'll notice that credit score can actually be used as a compensating factor. It's not a requirement. So on the previous slide for purchase transactions, it was required that all of the applicants had a credit score of 680 or higher. For refinances, it's not required but can be used as a compensating factor. All right, so now we're going to really shift gears and we're going to look at purchasing power tools. So these are strategies that can help borrowers qualify more comfortably and responsibly. Now, they're not shortcuts. These are legitimate options like MCCs, temporary buy downs, and voucher programs that can help reduce early payment shock and improve ratios in a way that supports long term success. For our guaranteed borrowers, used correctly, the tools can make home ownership more accessible while still maintaining responsible underwriting standards. So the first one we're going to look at is the mortgage credit certificates. These can make a meaningful difference for many borrowers, especially first-time borrowers. An MCC essentially converts part of the mortgage interest into a dollar for dollar federal tax credit, which can increase a borrower's usable income. It's important to enter the MCC information accurately in GUS so the borrower receives the full benefit. Now, I do want to point out that not every state offers MCC, so you always want to confirm whether the program is available in the borrower's area. Again, used correctly, MCCs can improve ratios and create more affordable payment scenarios for qualifying borrowers. Now, self-employed applicants, they are not eligible for an MCC. So if you have a self-employed borrower, unfortunately, this would not be an option for them. Temporary buy downs, those can give borrowers some financial breathing room during those early years of home ownership. The key rule is that the loan must be underwritten at the full note rate, not the reduced buy down rate. The buy down account must also be fully funded at closing, and the borrower cannot provide those funds themselves. When buy downs are structured properly and entered accurately in GUS, they can again help reduce the initial payment shock while still ensuring that the borrower can afford that long term obligation. All right, here we have the Section 8 vouchers. They are often an underused tool in home ownership. For borrowers who already receive voucher assistance, that support can be applied directly towards their monthly housing payment, reducing the amount that they must cover from their own income. And this can make a significant difference when those ratios are tight. It does require coordination with the local public housing authority, but when everything aligns, a voucher can help again bridge that gap between affordability and qualification. So it's always worth asking borrowers whether they are current voucher holders. All right. So next, we are going to kind of put all these pieces together. So we're going to be looking at putting together the ratios, the documentation, those purchasing power tools, and some more day-to-day scenarios that you are likely at some point to encounter. The more familiar you are with how these components interact with one another, the easier it becomes to approach files. So really it's about using the right tools at the right time and in the right way. Accurate GUS entries, they make a significant difference. Anytime you use a payment amount that doesn't match the credit report, you must document why and include that documentation in the file. Court ordered obligations should be entered manually and clearly labeled. Those buy now, pay later accounts, they must be captured if they appear on the bank statements. Gift gifts, those must be entered carefully. Make sure they are not being double counted, depending on whether they have already been deposited. And then all liabilities, just make sure that they are entered into GUS. If something is omitted, there must be supporting documentation showing exactly why that omission is allowed. So here, just another pro tip is just to check out the USDA link training and resource library. The GUS page that's part of the library is full of helpful resources and tips. So when you have time, make sure that you visit and explore all those tools that are out on that GUS page to help you out. All right, so here we're going to go over a few more scenarios that, again, kind of help put all of this into play. These we're just going to go over really quick here. So this one is an auto lease with 4 months left, and that is always included because again, remember those leases, we treat those where we always include a payment regardless of how many months are left to pay on a lease. Next example we have is a 401k loan payment. Those are not included, so you can exclude that from the debt ratio. Here, this one, we have a business paying a personal truck loan for 9 months. So does that have to be included or can that be excluded? And that one has to be included. Again, we only have a 9 month history. We don't have a full 12-month history with this one. So you got to leave that one in. Timeshare maintenance fee, again, those have to be included. We have a revolving account here with a zero balance. That one, you can leave that one out because there's a zero balance. And then we have an authorized user credit card. That one I put down as it exclude, just assuming that they have no legal liability to that account. But again, you need to double check those authorized user accounts and just make sure that they are not liable. So hopefully this quick recap of rules just helps make those ratio decisions a little easier as you work through some of your files. This slide here just highlights a few more common mistakes we sometimes see. One big one is using a $0 payment for those IBR student loans without applying that half percent rule. So again, we can never use a $0 student loan payment. You have to use, if there is no payment listed, you don't have any type of agreement, then we have to use that half percent rule. Another is trying to exclude cosigned debt when there isn't that full 12-month history showing the other party has made the payment. You need to make sure you have that full 12-month history. So avoiding these mistakes, it really is going to help you make sure that you have clean, accurate, and easy to underwrite files. All right, so just some major takeaways from chapter 11 here is sticking to the 29, 40, 1% ratios unless compensating factors apply. Make sure you know which debts belong in the ratios and which ones you can leave out. Apply that 10-month rule consistently for installment loans, but remember that leases never qualify for that exception. Those always have to be included. And above all, just make sure you document everything clearly in GUS and your loan file. I can't stress that enough. Just make sure everything is documented. All right. So as we wrap up today, if you haven't bookmarked the USDA link training and resource library yet, I've mentioned that a handful of times this afternoon. Make sure that you have that bookmarked. That is the greatest resource you will have. It really is your central hub for gaining access to our 3555 handbook, policy updates, user guides, training materials, and make sure you check back on a regular basis. That just helps ensure that you're always referencing the most up to date guidance. All right, this next slide here highlights our full training library. Here you can access recorded webinars. So after we wrap up this webinar today and we get the recording ready, we will place a copy of it out here on our lender training hub. So if you know somebody that wasn't able to attend today's event and you think it would be good for them to hear this, certainly direct them to this page and they can go listen to it later on. We also have some basic training modules out here. And then new lenders, we have trained the required training for them on here as well. And then recertification. So every 2 years, all of our approved lenders do have to go through recertification, which includes training. So that is posted out here in the training hub as well. If your organization ever needs custom training, you would like some one-on-one training for your staff, because I know these events, we only have, an hour, and unfortunately, due to the size of these groups, we're not able to do any type of live Q&A. So if your organization could benefit for something more personalized to your needs, just reach out to my team here, the Lender and Partner Activities Branch, and we will be more than happy to set something up with you. That 3555 handbook, that is your foundation for the guaranteed program. It looks a little bit different now, but it's the same handbook. Whether you read it online or you download a copy, please just always make sure you're referencing the most current version. Updates happen, and using an older version can lead to confusion or incorrect interpretations of our policy. So please make sure that if you choose to download a copy of it, that you do check back frequently and look to see if it's been updated. The search function, that is great. It will save you a whole lot of time if you know the topic that you are searching for. And that search feature there, the arrow just kind of pointed to it down at the bottom there, that's available whether you are searching the online version or you download a copy. Either one, use that Control F to find the information that you are looking for. All right, our FAQ resource guide. This thing is phenomenal. This is a great tool. This is where I got a lot of those scenarios that were in my presentation today. They come right from this FAQ guide. They are questions that you all have asked of us, and they needed a little bit more of how we interpret the handbook policy regulation into these real life scenarios. So all of that is posted in this FAQ guide. So another great reference to go out and search for those questions that might come up. This was just updated on May 4th. So if you haven't looked at it lately, please go and take a look to see all of the new FAQs that were added. You can quickly find what the new ones are by that. I just kind of highlighted that little new icon there that will identify all of the new FAQs that were added. All right. And then when something tricky might come up, don't worry, you don't have to navigate that alone. We're always here to help, depending what you need help on, whether it's policy, training, or a specific loan file, reach out to us and we can help you save some time and ensure that you're working with the most accurate guidance. One thing I do want to point out is that our contact information for our origination and processing division was recently updated. There used to be a couple different emails for you to reach out to. That all has been condensed into one email address now. So, regardless of where the property is located, if you have a question on a file that has already been submitted to USDA and you need to reach out to our origination and processing division, please reach out using that OPD1 email address. All right, so that is going to wrap us up for today. Before we sign off, though, I just want to say a big thank you for you taking time out of your busy day to spend time with us for this hour today. We really do appreciate you taking time to join this session. You can go out again to the link library and take a look at the rest of the sessions that we have coming up for the rest of this calendar year, and you can get registered for all of those coming up. So again, thank you. We're so grateful to work alongside all of you, and we're always here if you need us. So thanks, and I hope you have a great rest of your day.